Our next guest says that stocks are in a precarious position. Joining us right now is JoAnne Feeney, partner and portfolio manager at Advisors Capital Management. And JoAnne, do you really think stocks are in a precarious position? Because I read the rest of your notes and it sounded like you think the rest of the S&P 500 is finally catching up with those 7 big tech stocks that were on a tear earlier this year.
Well, good morning, Beck. Yeah, those two things do go together. We've had an incredible rally since the beginning of June, so that it's no longer the big 7 that have done well in the market, right? The other 493 have done very well. In fact, there are dozens of companies in the S&P 500 now trading at multiples of 30 times next year's earnings. So that's what I mean by precarious. Things are expensive. Not that you can't find bargains, and that's what we try to do, right, for our clients is look for other ways to be invested in this kind of a market where we do think valuations here are pretty high given the amount of risks that are out there still.
Does that mean that you are basically advising people, if you're in some of those big high-flying stocks that are at such high valuations, you might be selling some of those to put money elsewhere or to keep cash on the sidelines?
So what we are doing for clients and what we advise is to do a little bit of both, Becky, is to stay invested in some of the core growth companies, the things that are really powering the U.S. and the world economy, like Amazon, like Google. We have taken some money off the table, though, reduced our positions in something like an NVIDIA, for example, even in our growth portfolio. Because we do think its valuation is pretty high. We know we love the generative AI. We do think is going to be a growth driver for many years. And so that's why you do want to stay exposed to some growth. But we also think this is a time to look for those bargains, to also have some defensive and income generating positions in your portfolio, whether that's an AbbVie or a McDonald's or a General Mills or something in energy, which hasn't done well in the last several months.
What have you sold besides NVIDIA lately?
We've backed away from some China positions a little bit. We've backed away from some of the other higher valuation tech stocks and moved into some of those more defensive plays in consumer staples.
When you say you've backed away from some China positions, is that a valuation call or is that a concern about relationship between the United States and China at this point?
Well, there's nothing good about reducing the free flow of trade in goods and services. Right now, we're heading into a situation where investments are going to be more limited in China. We are liking some of the moves in China towards being the government being a bit more favorable towards tech. But we just view that the country as a whole as a place where uncertainty is perpetually going to be high in the degree of government interference in the private sector. So, rather than, looking at countries to invest in, what we try to seek out, particularly in our international team, is companies that are doing well, that are less vulnerable to the government interference around the region. So outside of China, we're finding a lot of good opportunities that are going to benefit from some of those concerns that are now pervading the China situation.
Let me ask you about Apple. That is a stock that kind of plays into both the theories and the theses that you just laid out, whether that be a very high valuation tech stock at this point, one that also has a lot of exposure to China. Apple's reporting its earnings later this week. Does that worry you? Would this be one of the high-flying tech names you'd pull away from, or is Apple in a different situation?
Yeah, Apple certainly has caught a lot of attention because of its high valuation. Now, of course, all these valuations that are quoted, Becky, you're right, are for the next 12 months of earnings. Right. Obviously, you're not owning Apple for just 12 months. You're owning Apple for many years. But it is a name that we're underweight relative to its market weight. We really think it's pretty dangerous here if you just track the S&P 500 in your portfolio. You're very overexposed to a handful of names. Those magnificent 7 that have really taken off are pretty expensive. So yeah, this is a name where we want to be underweight. We still want to own it because we do believe Apple is going to be a part of the U.S. and global growth story for many years to come. But we don't think you want to own it at the degree to which it is sitting in the S&P 500.
JoAnne, can I ask you about the Bank of Japan, what they announced on Friday, saying that they were going to allow that band to fluctuate higher, come off of zero interest rates, and then today the bank actively moving into the market and making some purchases of treasuries. What are they doing and what does it mean? I'm still trying to figure it out.
It's certainly roiled markets on Friday in ways that were unexpected. Clearly it caused investors to think, there's going to be more pressure for interest rates to rise, particularly the longer term rates. And that was new. And so you had to see an adjustment in that. So I think that their move towards greater flexibility is understandable. And the fact that they're recognizing they have less control over the yield curve is understandable. And so they just want to be positioned for that kind of flexibility to be able to source the funds they need to run the government.
And I guess finally, as we head towards this jobs report on Friday, the July jobs report that we'll be getting, there's all this talk about the economy potentially being in for a softer landing. A lot more people believing it than just even a month ago. Are you a believer in that? Do you think that this trend continues for the market based on what we're seeing in the economy? Or is this a momentum play that you worry runs thin if there's not as much money on the sidelines that's jumping in and following?
Yeah, Becky, I'll put my economist hat on here for a second. I mean, we have a perplexing situation. The consumer remains surprisingly strong. Inflation is coming down, but core PCE inflation, which is going to be a pretty strong signal of what's going to develop over the next several months, is still sitting at 4.1%. And that's double where the Fed wants headline inflation ultimately to go. So we know the Fed has a lot more work to do, and we recognize that investors may be underestimating how much more pressure is going to have to stay on the liquidity side of this market for longer. And so that's why we are thinking that the market might be in a precarious position. If the market is building in rate cuts early next year, we think that might be premature. But we have also pushed out our view of when a recession might come if it comes. And we've always been in the camp that the economy is pretty strong and that people have underestimated the resilience of the consumer. And look at housing. I mean, we've been on board with the housing trade for many months now because we see the structural shortage of new houses, and we recognize that that's an opportunity for many years to come. So a soft landing, we do think it's possible, but we also recognize that the Fed has still a lot of work to do, and investors should be prepared for interest rates to remain higher for longer, and for that ultimately to cap, some potential for a broad market rally, which doesn't mean that there aren't opportunities there if you look for lower valuation and particularly income-paying stocks right here.